Welcome guys to Travis's Trade. My name is Travis Khan, and on this video I want to talk about options trading. I know that's a topic that's been popular lately, especially the platform Pocket Option that's risen in popularity, especially after Trump won election. Financial markets are getting deregulated. So option trading can see significant new customers, right? Pocket Option is a platform that's getting popular, right? And well, I don't want to talk about the platform. That's a new pocket platform for trading options. I want to talk about options in general. What are options? Why they exist? How you can trade on them, and what you should be aware of when you're trading options. Okay, first of all, what's an option? In simplest terms, an option gives you the right to buy or sell an underlying asset at a predetermined price known as the strike price. So how does that look? You can buy an option to, let's say, buy Apple share at $300. So let's say currently the Apple share price is $220. You buy a share, you pay a premium. So premium is basically, so you buy an option. So Apple share right now is $220. You buy an option and you have to pay a premium to just buy the option. So the premium is just the cost to buy the rights to buy the option. And once you buy the option, let's say the option strike price is $200. Okay, and it's a long option. Okay, so you have put option and long option. Put option is selling, long option is buying. And basically, what that means is if you buy a long option of Apple share for $300 strike price, that basically means you're buying the right to buy an Apple share at $300. That's it. Okay. And it will have an expiration period. So it usually lasts 1 month. So the usual scenario is you're buying the right to any time within the next month buy a share of Apple for $300. That's it. That's a long option. And a put option, the other way around, is you're buying the right to sell an Apple share at $300, let's say, the strike price. So when you buy a put option of Apple share with a strike price of $300, so within the next 1 month at any time, you're you can sell an Apple share at $300. You're buying that right. That's it. It doesn't mean you have to execute or exercise your right, but you're buying the right. That's it. Now, why would people want this? Okay, why don't just go into the market and just buy the share? Why go through all this trouble paying the premium and all that, right? That's a pretty good question. Yeah. So as we were saying, why would someone want to buy an option when they can just buy a share in the open market, right? That's a pretty obvious question. And the reason is, first of all, option gives you the benefit to buy the share at a specific price. That's the fundamental difference. When you buy share in the open market, you have to pay the market price, which is changing all the time. When you buy an option, you have the right to buy or sell a share at a specific price. It doesn't have to be a share, it can be commodities, any other financial asset, but I'm giving using share as an example, stock market share. But why would someone do that? So why do you need to have a certain price at which you want to buy or sell a share? Well, then you come to the question of who's selling the option. Why would want to? The person who's selling the option has to do the exact opposite, right? If you're someone, you're buying an option, let's say at $300 Apple share. The person selling you that option that person has to have a share of Apple, and that person has to be ready to give sell that share at $300 within the next month, anytime. Why would a person do that instead of just, you know, keeping the share to himself and selling in the open market? Well, now you have to dig a bit deeper, which is that a lot of options don't get exercised, right? So let's go back to the Apple example. Let's say Apple current price is $200. Let's say I have a share of Apple. So I don't expect the price of Apple to hit $300 within the next 1 month. So I sell an option for anyone to buy the right to buy an option, buy a share of Apple at $300 within the next 1 month. So I have a share of Apple. Apple current price is $200. I don't expect the Apple price to hit $300 within the next 1 month. By selling an option, giving someone else the right to buy that share from me at $300, I'm basically saying to the market, I don't expect the price to hit $300. I can make money on the premium because the premium is paid instantly the moment the person buys that option from me. So options are usually sold by big institutional holders, people who have a large chunk of shares, so they can make a significant amount of money by selling premium, by selling options and not expecting the strike price to be hit, but they still make money on the premium, the right. And yeah, that's basically what it is. Okay. You have a share, you have a bunch of shares as an institution. You're selling someone the right to buy that share at a certain price. But if the price is not hit, or sell the share, whatever, I'm using buy as an example. But if the price is not hit, you still make money from the premium that the person pays you to buy that right. And now let's come back to the person who's buying the option. What's his benefit? Okay, if the institutional holders are thinking that no, Apple price is not gonna hit $300 within the next 1 month, it's highly unlikely. And but as a person buying the option to buy the right to buy Apple share $300 within the next 1 month, anytime, why is he doing that? Well, now you come to an simple concept in trading called upside benefits to downside risk, upside downside ratio, basically. The person who's buying the option, what's his upside? Anything above $300 is his upside, right? You buy the share at $300, you sell it above $300, you make money. So your upside is anything above $300 for the Apple stock. What's your downside? My downside is the premium I pay to buy that option. That's it, right? It's pretty simple. If I pay $10 to buy an option, my downside is $10. Okay. I don't have to exercise the option unless the price is above $300. So I'm losing $10. Compare that if I go to the open market and buy Apple share right now at $200. What's my downside risk? $200. Apple share could go all down all the way to $0. Not it wouldn't, but theoretically it could. So I have $10 downside risk versus $200 downside risk, buying an option and buying a share. So basically, in trading, you're trying to find what we call asymmetrical trading opportunities, where the downside is much, much less than the upside. And so when you buy an option, your downside is only the premium, which is usually much less in value than the actual share price. And your upside is anything above the strike price. If it's a buy option, long option. If it's the put option, it's the other way around, right? So by using option, you are creating asymmetrical trading opportunities where your upside is much, much higher than your downside. That's just a simple concept. I mean, then you have to calculate the probability of Apple price going above $300, how many times it went above $300 in the past, what were the conditions, how many such events happened in the past versus all the total events you divide. So you find the probability of Apple price going above $300. And then you multiply this probability with any potential upside. And so yeah, like I don't want to get too complicated, but in simple terms, if you're trying to make big money in trading, you're trying to find asymmetrical trading opportunities where your downside is much less than your upside. And the simple way to think about that is option has much less downside because you're only paying the premium versus buying a share where the downside is the entire share price that you're buying at. Now let's come to the person who's selling that option. Let's selling a long option, buy rights option. What's his upside in now? If I'm a big institutional holder, I have a bunch of stock, I'm selling options on it. What's my upside? My upside is the premium I'm raising, right? What's my downside? My downside is, well, if I have a bunch of Apple shares, let's say, and I bought them at, let's say, $200 or below, and I'm giving people the right to buy that share from me at $300, what's my downside? I'm still making $100 on the share at least, as the person who's selling the option. But this is where you come into the concept of opportunity cost. Let's say within the next 1 month, Apple prices hit $350. Okay, the people I've sold my options to, they exercise their right. They buy the Apple share from me at $300. So I have to sell the Apple shares to them and not to the open market. What's my opportunity cost? $50. I could have sold my Apple shares on the open market at $250, but because I have excelled my rights to my shares, I have to give them to the buyers of the options at $300. So $50 per share is my opportunity cost, more the money I could have made if I didn't sell the options, basically. So that opportunity cost has to be included in your downside calculation. Okay. And this is a tricky concept because you're still making money, right? If you have shares valued at bought at $200 or less, and people are buying it from you at $200, you're still making money, but you're not making as much money as you'd have if you sold at off market price at $350, right? So this concept is a bit tricky, but your upside as the seller of the option, long option, is the premium. You get the premium instantly. That's your upside. Okay. Plus, when they exercise the right and they buy the option from you at $300, you're making $100. That's your upside, right? The premium is locked in the moment they buy the option. The moment they exercise the right to the option, you get $100 instant profit. So that's also your upside. What's your downside? Just the opportunity cost. I could have sold in the open market at $50 more at 350. And so as the seller of the option, you also have an asymmetrical trading opportunity where your upsides are far greater than your downside. Okay. And that's just a simple idea of how options trading work. And now if you want to think about what this means when you're trading options in the market, it means that let's go back to the Apple example. The less the probability of Apple's share going above $300, right? The less the value, the premium of the option, right? If the probability of Apple share going above $300 in the next month is very low, people are not going to pay you a high premium to buy your long option. right? To buy the rights to buy the share. So when you're trading options on the market, just know that obviously there's a lot of calculations involved. I'll get into that in another video, but in simple terms, as the probability of the Apple share price going above $300 goes down within the next 1 month, the value of the option goes down, the premium paid on the option goes down, and the value of option is determined by anything value, supply, and demand. Okay, because people are willing to pay less premium because they want to have less downside, because the upside is now less, because there's less likely for Apple share going above $300. So that's how you have to think when you're trading options, right? And basically a matter of supply and demand. And here's the interesting thing about options: if you buy an option, you can trade it on the market. You don't have to hold it until a expiration date or to exercise the option. You can just sell that option to someone else. So yeah, you don't have to hold the option when you buy it. You can just sell it to someone else in the market. So not to get too complicated, in simple terms, let's go back to the Apple share example. If there's very little low example of Apple share going above $300 in the next 1 month, that option value, long option value will be very low and it'll come down. So any bad news event that might uh, make sure the Apple prices don't go above $300 in the next 1 month will bring the option value down of the long option of the Apple share. And yeah, so if you have a long option, you have to trade it, right? You want to sell that option before it goes down in value, or you can just incur the premium paid. Yeah, $10 premium, who cares? Yeah, sure, you can do that too. But the idea still remains. It's fundamentally you're trying to find asymmetrical trading opportunities. As the seller and buyer of the option, you're trying to find both of you are trying to find asymmetrical trading opportunities where your upside is much higher than your downside. Upside benefits is much higher than your downside risk. And that's basically why option came into existence to help traders find asymmetrical trading opportunities. Okay. And yeah, people usually buy options. They don't exercise it most of the time and they incur a lot of transaction costs or the money lost in premium paid. But the one or few times when the options are in the money, they make big. Okay, they make big money, which more than recovers the money lost in premiums in the all their options in the past. That's basically how option traders make money. Most of the time, they don't exercise the right to their option. If they can sell it in the open market, make a profit, they might. But most of the time, they're willing to incur a premium and lose money on the premium and not exercise their option. But the few times they're in the money, they usually make big and they more than recover all the premium they paid in the past. And yeah, that's just a holistic idea of how option trading works. I'll come back with details about the calculation, the mathematical calculations in another video. Until then, peace.